Hello there, this is James and you're watching Tixee Live. And a very good morning to all of you, and all of you a very happy Tuesday. In today's program, I want to talk about a little bit whether or not, well, that's the question really, whether or not the market is accepting the fact that a Fed pivot is far, far away and the implications of that. This is something we talk about a lot on the program, and we discuss a lot whether or not the market's kidding itself, which I've often asked the question. I'm just asking the question now whether the market realizes it's been kidding itself. But anyway, before we get into all of that, don't forget, these little videos are for educational purposes only, and in no way whatsoever should be taken as financial advice. I always suggest you do your own research and do your own due diligence. And of course, know the risks at hand before entering any trade. With that out of the way, let's get started. So, a question we've had on this program, we discussed it, is whether or not since the CPI reading, are we seeing a bull market or are we seeing a bear market rally? And I think the reality is beginning to sit in is actually a bear market rally, because the idea of a Fed pivot or slowing down interest rates or stopping next year is slowly beginning to vanish. And it's all building up obviously for next week. But, yes, we all sort of accept that next week the Fed is going to increase interest rates by 50 basis points, not 75, which is done on 4 back-to-back occasions, but to 50 basis points. But there's also now concern, and this is what's diminished the idea of the Fed pivot, is that they may do 50 again next year in the very first meeting, January, February time, because the market was sort of getting the impression that they're going to do 50 in December, which I believe they will. And then they were thinking they might do 25 come February. But I think now the market's thinking, no, it's going to do another 50 come February. In fact, like I say, the CME Fed tool, which we talk about a lot on this program when it's building up to the interest rate decision, they say it's 80% chance now of a 50 basis point rate hike. But that's not the thing. And I've said this, and I'm a bit surprised the market is only sort of really taking this in, okay? Because I've said this, and Powell has said it. It's not a question of maybe small increments or even the Fed stopping or doing a pivot. It's the question is, how high will the Fed go? Because they will carry on raising interest rates. Now the question is, obviously, we had James Bullard, a Fed member, said 3 weeks ago. He says anywhere between 5 to 7%. But now the general consensus is that the Fed won't keep raising interest rates till they hit around about 5.5 to 5.75, which is going to have huge implications potentially to the financial market, And that's the thing. Again, the market is finally, and we talked about it, because I'm not surprised. I'm surprised the market is waking up to this, because even Powell, Jay Powell said in his speech last week, yes, he admitted we might have to do a smaller interest rate hike in December, but he also said, and this twice he said it. We're going to likely go slightly higher than we initially thought, and we'll probably hold it for longer to bring down inflation. Hold it for longer. I mean, the market hoped 4.75. Then maybe the market hoped to them 5. But now chances are it could go even higher than that, which, like I say, could generally have big implications on this. Now, obviously, the next meeting is the 12th and the 14th. But the main reason why the market is slowly begin waking up, and again, I have no doubt the market will forget it because the market has a short-term memory, is obviously we've got this old problem again of good news is bad news again. When we have good economic data come out of the US, means it's bad news for the market. Now, like we said, yesterday's program in the US session, the US Services ISM PMI was announced at 56.5 versus 53.1 expected. But there's been quite a fair bit of positive US data. Yes, the headline rate was announced a couple of weeks ago at 7.7. NFP came in at 263 versus 200,000. And now obviously ISM services PMI came in at 56.5 versus 53.1. So good news again. So good news is good news for the US economy, but it's been taken as bad news for the markets. We'll have another look at the markets. And again, like I say, and this is something I've always said, I often talk about, but I'm not the only one who says that the Fed's not stopping. And I always ask the question why the market tends to ignore what is said. There's another individual, a very colourful analyst, a bit like myself, very colourful analyst by the name of Jim Cramer, very highly regarded, very well known. And he says there's 4 reasons why the Fed won't stop. I agree with many of these. Okay, number one, there's not enough people rejoining the workforce, which means it's tougher to fight wage inflation. Basically, that's it. Since the COVID lockdowns, okay, very few people after lockdowns have returned. There's quite a few people have returned back to work, but quite a few people have not. Okay, this is the problem. This is why at the same time why unemployment is still pretty low as well in both the US, and it's the same situation in the UK. People have taken early retirement, or they have remained off on sick leave for long-term illnesses. So there's not a lot of people returning to work, which also means at the same time that when there's a lot of job openings and your workforce is diminishing, companies will pay a little bit more, obviously, to keep them and to get them because they're desperate to get the necessary people they need. So that, again, makes it very difficult to fight wage inflation. Don't forget, as well as the NFP on Friday, we also had a boost in average earnings as well. That went up quite considerably as well. So that is another problem for the Fed. Secondly, the number of job openings is opposite to the number of job seekers. There's more certain openings for certain professionals to those who are actually looking for work. So again, people, when you find the ideal candidate or the candidate, you're so desperate to get them, again, you have higher wages. 3, there's large workforces in customer relation management, data analysis, and advertising, which means there's a lot of bloated workforce leading to future layoffs. Now, don't forget, we witnessed layoffs by Twitter, extremely bloated. Apparently, it's now being run by Musk and his dog. No, I'm joking. It's run by a lot smaller team than it was. We've had 11,000 layoffs at Facebook. They admitted they overexpanded too quickly. 10,000 plus from Amazon over the last couple of weeks, and now obviously Microsoft and Apple as well. So we are we have had a bloated workforce, which again is leading to future layoffs. So until we get further big layoffs, then of course the Fed's not going to be able to stop. Secondly, and finally, there's too many companies have been created in the past 2 years. In other words, we've had such a booming period with such low credit, because don't forget, interest rates have been low. So companies have managed to borrow a lot and expand and open new ventures, which have gone through a boom period, which of course, when you start going through the boom period, you're going to get a bust. So this is what we're seeing now. And obviously it takes time for all this capital they've borrowed and all the money for it to start to vanish for the businesses to try and stay alive. So still we start seeing businesses go bust. This is the thing. And these are his words. This is what he had to say. The market's hostage to the Federal Reserve. And that's, sort of sounds the sort of words I would put. Market's hostage to the Federal Reserve. And the Fed's not going to stop tightening until they see more evidence of real economic pain. Now, don't forget, unlike the markets, don't forget this. Kapow said many, many, many weeks ago, prepare for pain. Prepare for pain, because they need to inflict like a soft recession on the US to bring down inflation. So, like I say, no evidence of real economic pain, because we haven't. The labor market's still pretty good. Average earnings is good as well. Services PMI was good yesterday. And like I say, evidence of real economic pain. And unfortunately, we're not there yet. He goes on to also say, gaming out the Fed's next move is more of an art than a science. You got to figure out when people will start coming back to the workforce. Again, like I said, that's a big problem since the lockdowns. We are experiencing the lack of people going back to work. And finally, he says, and when money-losing companies will let workers go or simply go bankrupt. So again, we're waiting for that. And though, yes, indeed, we've had major tech companies who've really struggled, shed a good deal amount of people and that workforces, it's not enough. We need more. So this is the thing. So till we start seeing something like this, and I agree with him in many, many ways, that obviously the Fed is not going to stop. Anyway, before I move on to a couple other things, we have a look at the market, in particular the S&P 500, because it's looking very interesting. It's around that 200-day moving average, which I think is key. Before we do that, there's something else just as exciting I want to share with you. I'm a big fan of the Elliott wave theory as well, by the way.
Let's go.
Very big fan.
I traded the DAX in the morning. Showed some really good signs of volatility as well.
Anyway,
join James and Stefanos every Wednesday at 1800 UTC for another lesson at Tixee Trading School, your key to a better understanding of the financial markets.
That's right. So this is the Tixee Live presents the Trading School. The next episode, we've done 6 episodes so far. So we have the latest episode tomorrow at 6 p.m. UTC. The subject, myself and my colleague Stefanos, will be discussing and having a conversation about, and hopefully trying to explain it to you so you understand it, it helps you, is market sentiment, which I think a lot of people overlook. In many ways. One thing we're going to talk about in particular is the Commitment of Traders report, which professional traders use and institutions look at. And we're going to talk to you a little bit about that and explain how to read these reports and how to ascertain market sentiment by looking at these reports. Now, don't forget, this is a live show. Obviously, Trading School is live because Tixee Live means live, obviously, but it won't be on YouTube for another couple of weeks. It's not broadcasted live on YouTube. It's broadcasted on a different platform. To come along for the live event, click on the link on below or register on the link below, and hopefully I will see you all tomorrow. It should be a good one. Should be a good one. Anyway, another story before we look at the markets. There is someone else who's not slowing down with interest rates. I don't think any central bank at the moment it's going to be slowing down. And that's the Reserve Bank of Australia. They raised interest rates by another 25 basis points. Interest rates in Australia now lie at 3.1. And they went on to say, prepare for more. So they're not holding back as well. Whether or not market remembers that or listens to it, it's a different picture entirely. Let's have a quick look at the markets. Anyway, I want to start with the S&P 500. Now, like I say, this is on a 30-minute. At the moment, we're trading around, this is the futures, trading around the 4,000 point level, 4,020. And this is massive. And if we look at, this is on a daily, again, we're under now, just under that 200-day moving average. When we had broken above it, that's when we started asking questions, are we beginning to see a bull market, not a bear market rally? Now it's dropped back under that key level, 4,000 points at the moment. So now it is indeed under pressure. For us to get any bullish momentum, we need to get back above that. Don't forget Michael Wilson, who is one of the top strategists and has been voted #1 strategist from JP Morgan. He says he did see 4,150, and he was bullish for a couple of weeks. He's now gone back to being a complete bear. So anyway, that's a key area for me, getting above that 200-day moving average. But again, we're below it at the moment. Currencies as well. Don't forget the euro was above the 105 handle, slightly underneath it at the moment, though. Not complete underneath it. We are seeing a bit of dollar strength, but not a complete whitewash. 1.04975. Key level for me, both resistance, potential resistance, 1.06017. 200-day moving average, which is just above at the moment, 1.03882. Sterling's the same story as well. So we've seen a bit of a fight back. It was at the 122 handles, now underneath that, currently trading just above the 200-day moving average. Key area for me, 1.21092. Gold, of course, obviously. Go again to a $200 moving average. It's still just above it, $1,773.23. But it just could not break that key area we've been looking at for a while, which is $1,803.50. So yes, being held up at 759, which is the 200-day moving average. But like I say, could not break. So at the moment, it's pretty range bound on that. Dollar yen, I want to have a look at now as well, because we are above, again, the 200-day moving average for that. Key area for me, though, is that 38.2 Fibonacci retracement ratio, which is just above the 136.87 mark. So I'm keeping a close eye on that. 136.64 is where it currently trades at the moment. Other things to come. I mean, we've got a bit of a lighter calendar this week, but next week is crazy. Next week is going to be massive. And obviously we'll talk about that next week. But because next week we've got US CPI, which is going to be really, really key. And obviously the Fed rate decision, or the Fed meeting on the 13th and 14th, decisions come out on the 14th. We've got UK CPI as well, but really it's the US CPI and the Fed interest rate decision. But other things to come today, which still is going to be taught, not today, but this week, Australian GDP, EU GDP, which is tomorrow, Bank of Canada interest rate decision, which is tomorrow, and Michelin consumer sentiment. But as well as that, it's, any more further developments as well. Like I say, don't forget the Fed has gone on blackout, because they go blackout before they had their meetings. So we're not expecting any speeches from them, but we can keep an eye out for ECB members, certainly for the euro, because that's looking interesting at the moment. European equities, as they currently stand, FTSE in the red, negative 0.27%. DAX currently trading in the red again, 0.15%. Eurostat 50 currently trading in the red, negative 0.20%. So as you can see, the mood is slightly shifted. Again, we're a little bit range bound in general, in particular, but the mood is slightly off from what we've been seeing since, obviously, that CPI hope and the hope of the Fed pivot. Really, it was this NFP on Friday, the good job data and the average earnings, which goes to show the Fed has still got a lot to do, even though the Fed keeps saying that. I don't get how the market forgets. The Fed says it, and the market tends to forget what the Fed is saying. But anyway, don't forget, you can ask me questions anytime at all, or simply say hello if you like. Not a problem. Not a problem. You can share with me your opinions as well. Tell me what you think. Not a problem. If you think of a question later, you can put it on either, leave it in the comment section, YouTube or Facebook. I will see them and I will reply to them next time I go live on air, which of course would be later this afternoon around 3 p.m. UTC, discuss the US session. In particular, I'll be interested to look at Tesla when the US opens, because obviously there was reports yesterday of Tesla cutting its production in its Shanghai production facility. Cutting production on one of the models by about 20%. So Tesla will be quite interesting. And don't forget, the stock market didn't have a good day in the US yesterday. So a lot of it was in the red. So we'll be interested to see how it opens today. So please come and join me along for that at 3 p.m. UTC. If there is no questions, not a problem. Not a problem. Don't forget, if you're watching me on Facebook and you enjoyed this little video, by all means, give us a follow. If you're watching me on YouTube and enjoyed this little video, by all means, subscribe if you like. Hit the notification button so you know next time I'm going live. If you enjoyed this video, found it interesting and useful, and you put up with me, my overall top enthusiasm for the market, I simply cannot help. Then give me one of those. It's nice to know that you like what I do. Anyway, till next time, don't forget, these little videos are for educational purposes only. And in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research and do your own due diligence. There, I said it. And of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.